Good morning and welcome to the Haven Financial Group radio show. I'm Larry Kulvig, founder and CEO of the Haven Financial Group. On today with Kyle Thomas, certified financial planner on the Haven investment team. Kim, good to be with you again this week.
Thank you. It's good to be with you as well, Kyle. Great to have you like always.
Yeah, thank you for having me.
Absolutely. We're going to talk about the economy and your retirement today, Larry. I understand. A lot of things going on with the economy.
Yeah, ups and downs and rate cuts and more discussion. Always something in the news, negative or positive. It's always out there.
That it is. If anything rings a bell with you this morning as we begin this conversation and as it continues for the next hour, give us a call at 612-504-8400. That's 612-504-8400. We're going to talk about the Federal Reserve's interest rate decision. Of course, that being made about 2 weeks ago now. How inflation and interest rates impact your retirement. We'll talk about investment management principles for retirees, and we'll wrap the show up by talking about financial caution before transitioning into retirement. So Larry, let's get started with this. We haven't had a chance to talk about the Federal Reserve interest rate cut. Talk a little bit about what you guys thought, and was it what you anticipated and the impact that might have?
Yes. First off, it was what we were anticipating. We were thinking that September was going to be the first cut of the year, and it ended up being so that it was. And we are thinking right now that there will be 2 more cuts to end the year. So we got October and then December as well. And the reasoning for that is we've seen some softening in the labor market. And we've seen some business activity starting to slow down as well. And if we take a look at what the Fed wants to help stabilize is inflation and unemployment. So if the softening labor market continues, then that's going to support them wanting to lower rates. And also if business activity continues to slow down, that's going to help them want to lower rates as well, because that means that inflation is cooling. Mm-hmm. So they want both of those to be down, or they want inflation to be down and unemployment to be up, I should say, for rates to continue to happen. And since those are both happening, then we should expect 2 more cuts this year.
Kyle Thomas is our guest. He's a certified financial planner with the Haven Financial Group. Kyle, talk to the people who are listening about the direct impact a rate cut like this would have on them.
The first and foremost impact that this has is going to be on your investments, and specifically bond portfolios. It will impact stocks as well, but bonds for the most part, especially for retirees, because, well, a lot of investments for retirees are in bonds, right? And those interest rates, depending on whatever the Fed does, the interest rates on those bonds changes, whatever the interest rates do. So then the way that it works is when bond yields go down, the prices of current bonds goes up. And when bond yields go up, the prices of those current bonds goes down. It's an inverse relationship. Now, when you buy new bonds, because all bonds mature at some point, when you buy new bonds, you're going to have a lower rate than when you did, say, last year, because these rates are now coming down. So that's going to give you a lower return. And that's something that we need to plan for, because rates have been really strong on these bonds for the last couple of years, because rates have been high and they didn't come down like we originally thought they would. So the income from these bonds is going to change pretty dramatically if we keep seeing these rate cuts. And that's something that we really need to plan around and make sure that we have the income sources that we need.
Yeah, Kim, on the surface, to the listeners, a quarter point may not sound like very much at all. But for those that are planning for retirement, close to retirement, in retirement, it certainly has some real consequences to those savings accounts, the returns on those, as Kyle said, the bond market, the cost of borrowing, a variety of different ways it affects. So, the key is, and we say it every week, is folks just need to have a plan. This isn't the first rate cut. It won't be the last rate cut. And then there'll be interest rate increases. This goes on over time. Historically, it always has. It's just how do we line up our portfolios? How do we create the right balance? So when this does happen, we're prepared for it and we don't push the panic button like a lot of people do.
Have a lot of people been calling, and are they concerned? I mean, people who have a lot of money in CDs and that kind of thing have to be a little concerned about this.
They are looking for alternatives because let's face it, with CDs and high yield savings, we're paying 5+%. It was a nice breath of fresh air because for over 2 or 3 years we couldn't make even pennies on those accounts, and now these CDs are renewing, and they are calling and saying, well, what other options do we have? What is your money market? What is it that paying? What are some other alternatives to get some higher rate returns, whether it be again money market or multi-year guaranteed accounts or fixed annuities? And we're going to look and explore all options. There's no perfect investment option, but the key is looking at all the options and weighing, does it make sense in your situation or does it not make sense?
Sure. So, Kyle, let's talk though about a few of those options, because you've already stated that not just this cut, this quarter point, but we're going to see probably 2 more. So in the end, we could be, by year's end, we could be 3/4 of a point down from where we were as we stepped into September. So where would be some options for people, especially those who are already in retirement, if they want to protect against these rate cuts?
Yeah, that's a great question, and something that a lot of people are probably thinking about. And the thing where it always comes back to is our asset allocation and making sure that we're in a risk profile that works for us. But maybe we're going to be adjusting our portfolios because of these interest rate cuts, because we need to find an alternative here, because we're not going to have that same yield on our bonds. So maybe we allocate to some more stocks to try and make up for that decrease in bond yield, because those bonds are going to be less attractive with a lower rate. But on the converse side of that, bonds being less attractive, stocks can actually be more attractive, because when rates are cut, it increases the money supply, which increases people investing into the stock market, which increases the stock market valuations. So typically and historically, when rates are cut, the stock market also reacts in a positive way. So maybe that's the solution that we go for, and changing the asset class at a high level from stocks to bonds in that ratio, and changing that, because we need to figure out what your goals are. And the best way to do that is going to be an analysis of your investments and figure out where we need to go to and how we need to achieve that.
If your portfolio is well diversified, do you really need to do anything at all?
Yes, you always need to do something, and even if that's just checking in on it and deciding to not change anything, we need to always be prudent investors and make sure that our current situation fits our desired needs and goals. So if that's working with someone like us as an advisor or by yourself, it always needs to be looked at. And people like us, well, at least our team, I should say, we look at these portfolios on a daily basis. And if your advisor isn't looking at them on a daily basis, that might not be the best solution, because the market changes every day. I don't know if everyone knows that, but the market changes every single day, and we need to be able to react accordingly to that.
Kim, the question I would ask listeners, Kim, the question I would ask is, what season or phase of life are they in? Are they in the savings accumulation phase, where the element of time, they have more time to handle these dips? Maybe that is a great opportunity for somebody in that phase or season of life. If you're really close to retirement, you're in the transitional period where you're just right at the cusp of retirement, you're close to retirement or in retirement. Now this can deplete your savings a little bit faster than you may like. So the sequence of return risk becomes more relevant than ever. Or maybe you're well into your retirement years, and this volatility could disrupt your income streams, and that can cause some problems in retirement as well. So again, what season of life? How does it affect you? What types of alterations or modifications need to be done, if any? Or if you're already well positioned, you should always take a close look at this always to make sure that something doesn't need to be tweaked.
So, have you had an opportunity to tweak your portfolio, or are you looking for someone to help you do just that? The folks at Haven Financial Group can certainly help you look over your portfolio, or maybe you don't have one yet and you need one. This is the perfect time to give them a call. Tell them that you heard us here on the radio. It's 612-504-8400. That's 612-504-8400. We've seen our first rate cut this year, and we're most likely going to see two more before we get to 26. So this is the time that if you're questioning whether you're in the right place and you're concerned about your investments, this is the time to make that call. 612-504-8400. Now, a lot of people, I think, gentlemen, think that all of this talk of interest rates and inflation and so on and so forth is for economists and that they don't have to worry with it. But coming up next, we're going to talk about how inflation and interest rates can impact you. That's right here on the Haven Financial Group Radio Show.